Yes, good evening, class. Today we are going to look at an overview of financial statement. Financial statement are a set of reports that provide information about business financial performance and position. They are used by vendors. So basically, financial statement, it gives report about the business financial performance, it gives a report on how the business perform and the position of the business, which state is the business is it making loss, is it making profit, is it are the incomes coming in, are the incomes, or we are spending more. So it gives that overview. So they are used by vendors. Who are the people that use the financial statement? We have investors. So investors, we have creditors, we have and other interested parties. So it helps them to make decision about the business. So the three main types of financial statements are: we have the balance sheet, we have the income statement, and we have the cash flow statement. So those are the three main types of financial statement. So we look at the importance of financial statement. Financial statements are important for a number of reasons, including they provide information about business financial performance and position. So here the financial statement, it gives information about how the business is performing financially and what's the position of the business, what's the stand of the business. They help investors and creditors make decisions about the business. So here, the financial statement help investors and creditors to decide whether to invest in that business, or creditors whether to lend that business. So they help business comply with government regulations. It can easily help the business to comply with the government regulations by paying taxes, following the taxes, the government rules. They can be used to track business financial performance over time. So it can help to track the business performance, financial performance, how the business is performing over time. For example, it can help to track the expenses of the business. It helps to track the incomes of the business and the investments of the business. How much are you investing in the business, and how much income are you getting, and how much are you spending in your expenses. So it helps in that. So let's look at income statement. It can be known as profit or loss account. So statement of comprehensive income or profit and loss account, it's also referred to as profit and loss statement, that shows the revenue from operations, expenses of operation, and resulting net profit or loss. So here it shows the revenue from operation. It shows all the revenues from operations, and it shows all the expenses of operation, the revenue, the money that you get from your operations, and it shows the expenses, all the income that you spend, or your expenditure. So here, so it might result to net profit or loss. So you either get here in income statement, you either get a net loss or a net profit. So excess of income over expenditure. So that is profit. A profit is the excess of income over expenditure. You have more income than the expenses. So we have excess of expenditure over income, which is loss. So your expenditure, your expenses are more than the income. of an organization over a specific period of time. In short, statement of comprehensive income or income and expenditure account is an account compiled at the end of an accounting period to net results of operation. Excess of income over expenditure or excess of expenditure over income. So that is basically income statement. So profit and loss account indicates how the revenue, that money received from the sales of products and services before expenses are taken out, known as the top line. So are transformed into the net income, the results after all revenue and expenses have been accounted for, also known as net profit, or the bottom line. It displays the revenues recognized for a specific period and the costs and expenses charged against these revenues, including write-off, for example, depreciation and amortization of various assets, and taxes. The purpose of the statement of comprehensive income is to show managers and investors whether the company made a profit or lost money during the period being reported. So the income statement shows a business revenue, expenses, and profit or loss over a period of time. Revenues are the income that business earns from its operation. So basically this revenue, it's the money that you get from your operations, the money that you get from what your business is doing or what your business is running. That money is called revenue. So we have expenses. Expenses are the costs that business incurred in order to generate revenue. So the costs that you incurred in order to generate revenue. For example, we have electricity bill. It is an example of expense. We have rent, we have water bill, we have and so many others. Those are all examples of expenses, the cost that you put in order to generate that income. So we have profit. We have profits. Profits are the excess of revenue over expenses. So profit, it is after subtracting your revenue. You get your revenue, then you remove all the expenses, the money that you spend for expenses. The revenue that you got, then you subtract expenses to be able to come with profit. So the losses are the excess of expenses over revenue. So when losses are when the expenses are more than the revenue. So the profits are when the revenue are more than the expenses. That's when you know that you have made a profit or a loss. So how do you know that you have made a profit? You know a profit when your revenue are more. They are more than the expenses. So when you made a loss, how do you know that you have made a loss? You know that you have made a loss, or your business have made a loss when the expenses are more than the revenue that you get in. You spend more than the revenue that you get. So there you just know your business is making a loss. So the income statement, that we have the format. So basically we have T format and we have vertical or narrative format. So we are going to concentrate on the vertical format. So the vertical format, it has these 4 columns. This one is to write your details, and then this one is to write your amount. First, this one is to write your first amount, then this one after it is for working, then this one is for your final answer. So we have sales. We put our sales in the last column. So we less cost of sales. We have sales. So we less cost of sales. So our cost of sales, or it can be referred to as cost of goods sold. It is the carrying value of goods sold during a particular period. So this cost of sales are the goods that you sold in that particular period. So for example, we have the opening stock, the stock that you had at the beginning of the month, which is the opening stock, the stock that you started with. So we have it. Then and we add the purchases. We add what you bought, the stock that you bought, the new stock that you bought during the month. Those are our purchases. You add them to the opening stock to come up with the net purchase. We have to deduct returns from the purchases. For example, when you have returns outwards, when we have the returns, you have to subtract it from the purchases. So the return outwards, the money that you have. You subtract the returns from the purchases. So we less the closing stock. We less the closing stock, the stock that you had when you were closing the month. That is the closing stock. So you less it. You less it from after adding opening stock plus purchases, after subtracting the return outwards from the purchases. So you less the closing stock, and to be able to come up with the cost of goods sold. So after getting the cost of goods sold, we want to get the gross profit. So the gross profit, you get it by subtracting cost of goods sold from the sales. So you get the cost of goods sold, you less it from the sales to be able to come with the gross profit or gross loss. So here we less the operating expenses from our gross profit. So we have to identify those operating expenses. We have rent, we have electricity, we have salaries, we have many others. As long as you know it falls under expenses, you less it. So we get the total expenses. So after getting the total expenses, we want to get the net profit before taxes. So that net profit before taxes, it's you get the gross profit you less expenses from the gross profit to get the net profit before taxes. So we less the provision for corporate tax. Then we to get the net profit for the year after tax. So we add retained earnings. We add retaining earnings. Then we less a proportion. A proportion, under it we have a proposed dividend. So we transfers to reserve. We have proposed dividends, transfers to reverse, among others. So you add, after adding, you come up with the total appropriation. Then cumulative retained earnings. So at the end of the year, you'll be able to know whether it is a net profit or a net loss. So let's look at this example. This information was extracted from the book of South Sudan, of South Sudanese Blessed Enterprise Limited for the financial year ended 31st December 2021. So we have the particulars, we have a debit side, we have the credit side. We are given cash, we are given bank, we are given data, we are given stock, vehicle, equipment, purchase, wages, electricity, rent, and bad debt, sales returns, sales discount, drawings, creditors, income tax payable, purchases returns, discount received, sales, provision for bad debts, capital, long-term bank loan. So we have additional information. Closing stock at the end of the year was valued at 1,500. Then we have additional provision of 1% of the debtors has to be made against bad debts on 31st January 2021. Of the rent paid, 100,000 is for the financial year commencing on. Then we have wages of 300,000 accrued. Then we have motor vehicles are to be depreciated by 20% and equipment by 10% on cost per annum. Then we have here we can prepare journal entries for all the adjusted and the statement of comprehensive income for the year. So when you're giving additional information, you need to prepare journal entries for the adjustments and the statement of comprehensive income. So let's start up. We start with when you're drawing journal entries. You start with the name of the company, which is South Sudanese Blessed Enterprise Limited. Then we are journal entries for the year ended December 2021. So we have the particulars and data. We have debit side, we have credit side. So we have the closing stock, which is 1,500. So we are going to start with the closing stock at the end of the year was valued at this. So we enter it, the closing stock, which was this. Then we have trading account, which was this. Then it is balance. Debit it's the same as credit. So let's go and look for the second statement. Additional provision of 1% of debtors has to be made against bad debts. Has to be made against bad debts. So they have given us the data that provision of 1% of the data has to be made against bad debts. So let's what are bad debts? Bad debts are outstanding balances owed that are that are no longer deemed recoverable and must be written off. So these bad debts are the people that you gave your money. These are the debtors that have failed to pay back your money. So they become bad debts. They failed to pay the money. So they're saying additional provision of 1% of the debtors has to be made against bad debts on this. Yeah. So the debtors, we have 1% of the debtors that become our bad debts. So we calculate it. We put the amount of bad debts, which is 3,000. So the provision for 30,000. So we come to our question and we look for bad debts. Bad debts, we have 30,000. Provision for bad debts. We have our provision for bad debts 60,000. Then provision for bad debts is 30,000. So you come here and we look at how we have done the bad debts. Yeah. So here we have additional provision equivalent to 1% of debtors to be made. We have the additional provision, which was 3,000 times the 1%, which gives us 30. So this means that there were additional bad debts expense of 30% of 30 shillings, which must be added to the existing figure. So the bad debts as per trial balance is 30 and the additional provision debts was 30, which gives us the total of bad debts figure to be taken to the profit and loss account. So it means here in our question, let's look at our we have to see our datas. Our datas was 3 million. So because in our statement they have told us that in our additional information they have told us that additional provision of 1%, so you have to get the 1% of the data. The data were 3 million, so you get 1% of 3 million to be over to get the amount for the bad debts. So here we have the bad debts, which is when you calculate you get the 30, and then the provision for bad debts we have 30. So when you total up, you'll be able to come with this this provision for bad debts, which is 60. So will we look at another additional information of the rent paid? 100,000 is for financial year commencing this. So the rent, remember in our question, the month was of December 2021. And then here in our additional information they are saying of the rent paid, so it means the rent that was paid, the 100 is for the financial commencing 1st January 2022. It means 1st January, it is before, it is in front, we have not yet reached January, we are looking at December. So it means it has been prepaid. You have paid for the month that you have not yet entered to, so it is prepaid. So let's come here to our additional information and we see. So we have prepaid rent and we have the rent. So let's see how to calculate that. So rent, of the rent, 100 was prepaid. Because much as that rent was paid for financial year ended 31st December 2020, it is for the following financial commencing this. This prepaid rent must be subtracted from the rent paid. So this is necessary to match expenses accurately against revenue and to the period they relate. So you come back to our table and to our books that you are provided with and you look at rent. Rent was 700. So to come up with the prepare with the money that was remaining for rent for that year, you get the 700. You get rent as per trial balance, it is 700. Then we less the prepaid, which is 100. So the prepaid rent was 100, which you come up with 600. The rent to be charged in profit and loss account or statement of comprehensive income is 600. So here it means our prepaid rent was 100 and then the rent was 100. We want to balance up. That's why we put yes, rent was 100. Then we go to wages. Our wages was 300 and then accrued wages or wages payable was 300,000. So we go and we look at what are the criteria of dealing with accrued wages, unpaid or outstanding. Accrued, it can be owing, outstanding, if the money that has not yet been paid. Wages of 300 accrued. Whenever an expense accrued, it must be added to that expense account figure already in the trial balance or created if it didn't exist in the trial balance. In this case, wages as per trial balance were given the amount, which was 1 million, and we add the accrued wages, which is 300. So here we have to add to get the total amount of wages. So that the total to profit and loss account is 1,300. This is the amount that we shall take to the profit and loss account. Accrued wages or wages payable must also be recorded under current liabilities in the statement of financial position. So under statement of financial position, we shall record only accrued expenses. Accrued wages or wages payable appear in each statement of financial position as a current liability. So let's look at motor vehicle are to be depreciated by 20% and equipment by 10% on cost per annum. What is depreciation? Depreciation is reduction in value of an asset with the passage of time, or it can be due to particular wear and tear. So for example, the fixed assets, they can always depreciate. For example, if you buy a phone, if you buy a phone, then you use that phone for like 1 year, you will not sell the same amount that the one that you've bought. So you will sell at a lower cost. So it means it has depreciated. When you buy a car, then you use it like for 2 years or 1 year even, you will not sell it at the same cost, meaning it has depreciated its value. All the equipment, they depreciate, they lose value. So the motor vehicle are to be, all the fixed assets, they depreciate apart from land. Land does not depreciate, though it's an example of fixed assets. It doesn't depreciate. Because you may buy land at this point at this amount, and then in the next year or probably in the next 2 years, you sell it, but you sell it at higher price. So land does not lose value, it does not depreciate. But all other examples of fixed assets, they depreciate apart from land. So motor vehicle are to be depreciated by 20% and equipment by 10% on the cost per annum. So to get this money over depreciation, to know the amount that was depreciated, you get the 20% of the motor vehicle. You multiply 20 over 100 times the amount of the motor vehicle. The same to equipment. 10 divided by 100 times the amount of the equipment. So let's look at So we are going to start. That was our journals. Those journal entries, they help us a lot in creating the income and loss account, or in income in balance sheet. They help us a lot. So that's why when you're given additional information, you're supposed to first do the journals. You first enter the journal entries by balancing each. So South Sudan Blessed Enterprise Limited statement. What are you preparing? Statement of comprehensive income, and for which year or month? For the year ended December 2021. So usually the statement of comprehensive income, it is prepared at the end of the year, the end of each financial year. So we have our sales. We start with our sales. We start with our sales. With our sales. We start with our sales. So we go back to our information that we are provided. We look for where sales is. We come and look for sales. We have sales. Yeah, sales are here. We have sales. So the amount for sales, we have 12 million. So that 12 million is the one that you bring. Here we have our credits, debit, credits, debit. Here we have our shillings. So here it's normally for calculating, even here for calculating, and then here is you write the final answer. So we have sales. We put the amount of sales. You can either choose to write here or the final column. It doesn't have any effect on it as long as you put the right amount. But it's basically right to write it. When you have cancellation, you write it here, then you put the direct answer. So we have the sales, which is 12 million. So we less the sales returns. We less the sales return from our sales. So this sales returns, when you sell, so this sales return, when you sell your goods, those goods that are usually returned back. So you have to remove it from your sales because you've not gotten that money, because you were given the goods back and you have to remove it. You have to subtract that money. So at times your customers may buy your products and they find out that they have they are damaged or they are expired, so they have to bring them back, which means your sales have reduced. So you have to, with less sales return. So after we have the 50 amount, so we less it from our sales to get 11,950,000. So we less cost of sales. So under cost of sales, we have the opening stock. So the opening stock we were given, it has 60. So we add the purchases. The purchases, they were 4 million, the purchases. So we add purchase returns. We subtract the we subtract purchase return from our purchases. Our purchase returns, those are the goods that you take back to your supplier. You find out that you bought goods, but at your when you reach to your company, you realize that those goods were damaged, or they were having they are expired, or having or they are less of the amount that you ordered for. So you have to take those purchases back. So that's purchase return. It means our purchases will reduce. So we shall get the net purchases, which is 3,500. So here to get we get the cost of goods available for sales, which is 41,440. 4,100,000. 4,100,000. By you add the opening stock, which is 60, you add it to 4 million, then you subtract the 500,000 to be able to get this. So let's look at so you less the closing stock. The closing stock was given to us in additional information, which is 1,500,000. So to be able to get the cost of goods, you add cost of goods available for sales plus you less after lessing the closing stock to get this one. 2,600,000. 2,600,000. So we have gross profit. This gross profit, we get it from lessing. You get the sales, then the net sales minus, you subtract the gross, sorry, you subtract the cost of goods to be able to get this amount, the gross. So if you get it in positive, it is gross profit. When you get it in negative, it is gross loss. So after getting the gross profit, we add the miscellaneous income or revenue. So miscellaneous income or revenue, we have discount received. That discount received, it is the when you go to buy a product or good and you are given a discount. Maybe the good was supposed to be sold at 2,000 and then the person, then you were able to negotiate and you buy it at 1,000. So that is the discount received. It means you have received that discount. So it becomes part of your income or miscellaneous income or revenue. So it is 80. So we less operating expenses. We get all our operating expenses that we had in the exercise, in the example that we have, sorry. So we have wages, which is that, we have electricity, we have rent, we have bad debts, we have sales discount, we have depreciation, we have equipment. Those are all expenses. Equipment notes. So after we get the total expenses, after getting the total expenses, we get this amount, we subtract our amount, which is 9,430,000 from, we subtract it, we said 5,170,000 from 9,430,000 to be able to get the net profit before tax. So we have gotten our net profit before tax. So in our example, we don't have any task. There is no task. So if there is no task, it means we are not going to, this is our net profit for the business. So if there was some tax, so that's when we shall be able to put the taxes. But there is no taxes, so our profit before taxes. So that marks our final answer. So we have looked at this note, so you have to be very keen about this note. So let's look at statement of financial position. A statement of financial position is a snapshot of a business financial condition at a specific moment in time. A stock is the least liquid or more permanent than other current assets, and cash is the most liquid or least permanent. Therefore, stock appears first on the top and cash least bottom in the arrangement of current assets. So here when we look at the statement, these are another notes, sorry. A statement of financial transaction. Such period could be after a month or a year. So statement of financial position, you may prepare it after a year or a month. It depends based on the organization guide manual. So it depends on the organization or the business. A statement of financial position comprises assets, liabilities, and owners or stakeholders' equity. So assets are divided into fixed current assets and intangible assets, whereas liabilities are divided into short and long-term obligations. However, assets can also be short and long. Example, cash accounts such as checkings, money market, or government securities. At any given time, assets must equal to liabilities plus owners' equity. So we have to follow our financial equation. So which is asset is equals to liabilities plus owners' equity. When you're preparing statement of financial income, that should come in your mind that we are targeting for the equation, for the accounting equation, which states that asset is equals to liabilities plus owners' equity. An asset is anything the business owns that has mandatory value. Liabilities are the claims of creditors against the assets of the business. So an asset is anything the business owns. It is the thing. It is anything that the business owns that has mandatory value. So that liability are the claims of creditors against the assets. So it means it's an obligation. Liabilities are the obligations of the business, whereas the assets are the resources of the business. So the balance sheet is a snapshot of assets, liabilities, and equity at a particular point. So assets are resources owned by the business, liabilities are the debts owned by the business, equity is the owner's investment in the business. So let's look at the statement of financial position, what it will help you to answer the following questions. Is the business in position to expand? So when you create a statement of financial position, you'll be able to answer the question that the business in position to expand when you see when assets are equals to liabilities. So it's your business having that opportunity to expand? Is it capable of expanding? So can the business easily handle the normal financial ops and flows of revenue and expenses? Can it handle? Should the business take immediate steps to bolster cash reserves? Is the receivable cycle lengthening? Can receivable be collected more aggressively? Is some debt uncollectible? Has the business been slowing down payables to forward still an inevitable cash storage? So those are the questions that help us to answer. So we are going to use the example that we had for that we had used it for our statement of comprehensive income. So it's the same example that we are going to use. South Sudan Blessed Enterprise Limited statement of a financial position as at 31st December 2021. So here we start with the assets. So we have fixed assets. Under fixed assets, we go to our question and we identify the example, the fixed assets that were given. So the fixed assets that were given, we have equipment, we have vehicle costs. So those are the assets that were given, fixed assets that were given. So you come to your income, to your balance sheet, and put the amount of the vehicle, vehicle cost. So this is the way we calculate the fixed assets. We have 3 columns: shillings, shillings, shillings. So we have the cost, we have the depreciation, and we have the net pay value. So we have 7M. The cost for the vehicle in the table, we were given 7 million, and then it depreciated by 1,400. So to get the net pay value, we subtract. Net means subtraction. So we get this 7 million minus the depreciation amount to get this. So you do the same with equipment. The cost were given this, and the depreciation, after calculating, we looked at it, and then we got this, which we get after that we subtract the cost minus depreciation to get the net payable value. So the total for the cost is this, but we are interested in the total for net book value. That's what we are interested in. So we are done. Then we get current assets. So current assets, they don't have that formula. This formula is only for fixed assets. So our current assets, we have stock. The amount which was given us, it was 1,500,000. Then we have debtors, which is 3 million. Then we less the provision for bad debts, which is 90. To get which is 90. This 3 million, you less the 90, then you get this. Then we get the prepaid rent, which is 100. We have bank, we have cash, which is this. Then we come up with the total for current assets. So we have the current, we less the current liabilities. We may choose to use this by lessing the current liabilities from our assets. So we less the current liabilities, which we have creditors, we have income tax payable, we have accrued wages, which is this, and then we have working capital or net current assets will be this. So we get net assets, which is 12,000 plus this, which is 12,110. So we come and we say financed by capital. We bring the amount of capital that we're given, which is 7 million, and then we add the net profit, which we got from our comprehensive, from our loss or income statement, which was this, the net profit. So when we add, we come up with this 12,170,000. So we less the drawings, because the drawings, they affect the capital. Drawings, these are the money withdrawn for personal use. It always affects the capitals. That's why we less it from capital. So we have owner's equity. Owner's equity we are given, it is this. Then we have long-term liabilities. We have long-term bank loan. Then we have capital. We get the answer that we get after calculating this. We get the capital employed. So that is the end of our income statement. That's profit balance sheet. Then our balance sheet is balancing, because here we have the net assets, we are having this, and when you add capital plus liabilities, we get this. So our amount is the same. So it takes us back to our equation, which is assets is equals to liabilities plus shareholders' equity. So let's look at cash flow. The cash flow statement shows our business inflows and outflows of cash over a period of time. So cash flows can be from operating activities, investing, or financing activities. Operating activities, these are the day-to-day activities of the business that generate revenue and expenses. So are these operating activities? They are day-to-day. They occur every day activities. Those are the activities that you do every day in your business that give you revenue and the expenses. So investing activities are the purchases and sales of long-term assets. So those are when you're buying that assets, or when you're selling an asset, that is investing activities, you're investing. Then we have financing activities, other activities that involve raising and repaying debt. So this, you either raise or you pay the debt and equity. So thank you. That marks today's lecture. We shall meet in the next lecture. Thank you.